So most investors have been told kind of a lie for the past 30 years. It's been, max out your 401k and your IRA, put as much as you can in. And unfortunately, what that's resulted in is potentially a ticking time bomb in taxes when you retire. So between the massive RMDs you can potentially get in retirement from these accounts, increases in things like IRMAA and NIIT, which we're going to talk about, and increasing your ordinary income rather than being able to be tax advantaged, there's other options. And so today we're going to talk about the taxable brokerage account. It's kind of like the ugly stepsister.
Just the title of these accounts. I mean, the IRAs and Roth IRAs and 401ks, they're all considered tax advantaged accounts. And then you got these taxable accounts that sound scarier than they are because you're thinking, I don't want to get taxed.
Right.
I don't want to have to pay taxes on my investments. But there's a lot of tax advantages that we'll get into about having taxable accounts.
Yeah, you can make a taxable account tax efficient.
Exactly.
Right? And tax advantaged in a lot of ways. So today we're going to dispel the myths about your taxable brokerage accounts and why they might actually be a perfect or more perfect fit than just relying on tax deferred accounts.
So let's actually start by walking through a little bit of a scenario to kind of explain the potential advantages of taxable accounts. So basically, let's just imagine that most of your assets, $2 million worth, are tied up in tax deferred accounts like IRAs and 401ks. This
Traditional.
Traditional,
So traditional IRAs, traditional 401ks.
And this is common. As financial planners, we see this a lot where people throughout all their working years just consistently contributed to their IRAs and 401ks and never really ventured too much outside of those traditional tax-deferred investment accounts. The big issue with these types of accounts and having most of your assets, especially as you get into the millions of dollars in these assets, is ordinary income issues.
Right. Every dollar that comes out of a traditional IRA or a traditional 401k is taxed from dollar one, and it's taxed as ordinary income. So you're not going to be able to do things like you would in taxable accounts, like taking advantage of lower long-term capital gains tax brackets, as well as strategies like tax loss harvesting. And we'll talk about that in a couple minutes, but what are some of the other things?
Well, so RMDs can become a big issue. I mean, this is kind of like a ticking time bomb, like what I think you referred to. So RMDs, basically, depending on when you were born, starting at 73 or 75, the government basically says, we've given you years of tax deferral. Now it's time to start collecting that money and paying taxes on that money.
Whether or not you need it.
Yeah. So we've seen in certain scenarios where someone's built up a lot of assets in 401ks and IRAs, and now they're taking these large RMDs. They get larger and larger as you get older past that RMD age. And that RMD that they're not fully using is increasing their taxes.
Yeah, and that creates two other problems too, because if their ordinary income is too much, it also triggers two other taxes. One is called IRMAA, which stands for
Income Related Monthly Adjustment Amount. It's basically a surcharge on your Medicare premiums that you're paying once you reach a certain limit.
And then that can actually double or triple your premiums. And then the second one is called NIIT.
Yeah, NIIT.
Right?
So NIIT is Net Investment Income Tax. Again, this gets triggered at a certain limit. I believe it's about $250,000 when you're married filing jointly. That's for 2026. But this is an additional 3.8% tax on investment income. So this is all to basically say that having all your assets in one type of tax bucket, like a tax-deferred account, can cause these big issues when it comes to your tax bracket in the future and paying ordinary income taxes.
So what we're proposing is, what if instead of everything that you can save, you save in tax-deferred accounts? What if we took a scenario of splitting it 50-50, right? So we have someone who has $2 million and $1 million that they saved is in their tax-deferred accounts, traditional Roths, traditional 401ks, and $1 million is in taxable accounts. What type of strategies does that open for them, and what kind of benefits could they realize before retirement as well as in retirement?
Yeah, because from an outside perspective, not knowing too much about these types of accounts, again, you hear that taxable accounts, and you're like, $1 million in taxable accounts, I'm being taxed on $1 million. This is not worth it to me. But really what we're going to talk about are some strategies that actually can potentially help you pay less in taxes over time and give you more flexibility. So starting with being able to actually manage your tax brackets a little bit better. Like we said with the tax-deferred accounts, every dollar that comes out of those tax-deferred accounts are taxed as ordinary income.
And for high net worth investors, that could be 22, 24, up to 37% taxes, even in retirement. Because a lot of times high net worth investors, their tax bracket doesn't drop very significantly in retirement, especially if they have to worry about things like RMDs.
Exactly. But then if you contrast that with the taxable accounts, the highest you could be taxed on taxable investments,
Long-term capital gains.
long-term capital gains wise, which is held for longer than 1 year, is 20%. So if you're used to paying and you're going to be paying in your retirement in the 24 or up to the 37% tax bracket, why wouldn't you want to take money from your long-term capital gains at 20% or even less in some cases, 15 or 0% depending on your income? But why wouldn't you want to take money from the lower taxed investments than the higher taxed investments?
Yeah, and so we're going to get into this a little bit later. It's very important that you do a couple critical things in retirement, or actually before retirement, with these types of accounts as you're saving in them. But the idea is long-term capital gains are taxed at lower rates overall for high net worth investors than ordinary income rates from your IRA. Another thing is that you don't have contribution caps. So you can contribute any amount that you want to a taxable account. And then getting back to the taxability, one of the advantages of having money in a taxable account is you can sell specific lots of your investment, right? So if you've bought an ETF or you've bought a stock over multiple years, right? You can decide which time period to sell in your account. And so you can manage your taxes throughout retirement. So you can sell things that have long-term capital gains in some years where you need that tax advantage. And in other years where you don't need the tax advantage, you can sell things that have shorter term capital gains.
Some of the money that you've invested in the taxable accounts over the years can come out with no taxes at all because it's the basis of your investment. The other part of the lots that you're talking about is you can actually sell certain lots at a loss. This is what's called tax loss harvesting. So basically, if you have let's just make it simple and say you bought Apple and Apple stock went down and you lost about $10,000. That $10,000 loss can be used against any capital gains or against your ordinary income.
And it doesn't have to be something that you permanently sell. So with tax loss harvesting, as long as you've sold the investment and you haven't bought back that same exact investment for 31 days, right? Then you can still own the stock or the ETF or the investment long term, but still take the loss off on your taxes. So that's a really important and powerful way to stay invested in an investment, yet to use short-term losses in order to get tax advantages. So another advantage that's not used very often by most investors, and you have to really be careful because it's a more sophisticated strategy, is when you have a taxable account, you have the ability to use what they call margin, which is the ability to borrow against your stock to buy more investment, or potentially to use it as a short-term loan for things outside of your investments. Start a business, right? Or borrow to buy a house without having to cash in the investments. Now, it's a double-edged sword because you're paying interest on this, and you also have to watch, and you don't want to use this for volatile investments. But it's a strategy that's better than a lot of times borrowing from your 401k. And it leaves a whole bunch of tax advantages potentially open that you wouldn't otherwise have.
Exactly. And I think one of the biggest perks of having this 50-50 split in this example is liquidity. So you can tap this taxable account, like you said, for anything at any time. It's not locked up in a 401k. or an IRA. So the benefit of this is that it kind of unlocks certain strategies like Roth conversions, which we've done a video, our last video on this, kind of talks about these gap years that I'm going to talk about. But basically having taxable investments to cover your living expenses from the point of when you retire to the point to where you're taking Social Security or potentially collecting RMDs is a great way to manage your taxes during those years so that you can do certain strategies like Roth conversions. But if you want to learn a little bit more about that strategy, feel free to check out our last video on that.
Yeah, and we use the taxable accounts for that bridge strategy. The bridge strategy or the gap strategy is when you want to retire before collecting Social Security. The taxable account is a great way to be able to live and fulfill your early retirement dreams.
Yeah.
And the way that you'd like to.
Yeah, definitely. So going back a little bit to the beginning of the video where we talked about NIIT and IRMAA. So this is really where I think the taxable accounts can really help avoid these additional surcharges and taxes, because having the taxable accounts, and let's say you withdrew $100,000 from a taxable account, it has much less of an impact on these two specific taxes that we're talking about than if you withdrew $100,000 from an IRA. These taxes are triggered by your ordinary income, and like we said, taking out of taxable accounts is usually and preferably just taxed at long-term capital gains brackets.
Yeah. Now the caveat of that is we're assuming that as this taxable account has grown, that you've done tax loss harvesting and tax strategies for that account that mean that most of the money that you're taking out is either long-term gains or principal. If you don't manage that account correctly, we're going to talk about that in a couple minutes, it could actually create more of a burden over time. So taxable accounts can be a fantastic way to kind of mitigate the negative effects of retirement accounts. But like anything else, if you use them incorrectly and you don't employ strategies while the money's growing, they can present almost just as much of a problem, if not more in some cases. Roth 401ks are also fantastic, and Roth IRAs are also fantastic. Taxable accounts may, in some instances, trump the Roth because of the ability to withdraw the money prior to retirement. Roth IRAs and Roth 401ks can become even more powerful than taxable accounts, and we have a video on that also.
Yeah.
The caveat to all this is everyone's situation is going to be unique, right? So what we're talking about today isn't advice for you. It's education designed to help you think about what your situation might look like.
And clear up some of the fears around the taxable accounts.
Right. So although taxable accounts can be a fantastic addition to retirement funds, if they're not managed correctly, then they could actually be ticking time bombs in themselves. So here's some examples of things that you need to watch out for so that your taxable accounts don't go horribly wrong and create more of a tax burden than you would have thought.
Yeah. I would say the first one that comes to mind is putting the wrong types of investments in taxable accounts. Things that are going to be high income producing investments, and during your work years, this could actually make your tax situation worse.
So for example, in taxable accounts, you want things that have the least tax consequences, right? So exchange traded funds and stocks where they have low turnover, right? So hopefully you're not buying and selling your stocks a lot. If you are, then you put them into a tax-deferred account like an IRA. But if you're not buying and selling things a lot, or you have an ETF that has exchange traded fund that has low turnover, these are great for taxable accounts because you're not going to get a tax bill or much of a tax bill each year, yet you're going to still get growth. Also putting things like investments that pay what they call qualified dividends. Qualified dividends are tax advantaged dividends. And so they're taxed at long-term capital gains rates, not ordinary income rates. So you have the chance to get a 6% dividend on a stock that's in the United States that's not a REIT or certain other types of stocks, but that 6% will be taxed at 0, 15%, or 20% rates rather than 22, 24, up to 37% if you're a high net worth investor. So putting the right investments in the right account, tax advantaged versus taxable accounts, is extremely important in order to make this strategy work effectively.
So then the other side of this is tax loss harvesting. So I talked about this a couple minutes ago, but it's almost essential for these types of accounts.
Yeah. I mean, we've had clients that have come to us who have had taxable accounts, which was a great thing to do, that have grown to $1 million or more. But by the time they come to us, they haven't done strategies like tax loss harvesting. And so what's happened is they now have these accounts with high turnover investments that have very low cost basis and are paying out literally $100,000 or so in capital gains each year. So although a lot of those capital gains are tax advantaged, not all of them are, because a lot of them are being paid out as short-term capital gains. Because of the high turnover rate of the funds, they're actually being taxed on money that they're not withdrawing from those accounts, and is causing a larger tax burden than they would have ever anticipated before. So if you do these types of accounts, setting them up correctly is crucial. If you set them up correctly, they can be so powerful towards your retirement. But caveat emptor, right? You have to make sure that you know what you're doing and that you do it correctly.
Yeah, and then that goes back to something we probably mentioned in every video: having a financial plan.
Yeah.
Knowing what you're doing with these specific types of accounts, and a good financial plan should be able to kind of predict potentially your future tax situation when it comes to these types of accounts. But really, to kind of conclude this, the point of having the taxable accounts is not because they're on paper so much better than IRAs or Roth IRAs or 401ks. It's really because it gives you the flexibility to take advantage of other tax strategies that you may not have been able to before, and hopefully help you reduce taxes over time.
Yeah. Having 3 buckets to us, or 4 buckets in retirement, which is for most people Social Security, Roth IRAs, regular IRAs and 401ks, and taxable accounts, gives you 4 legs to a stool.
Yeah.
So now you can manage your taxes, manage your tax bracket, and try to pay the least taxes through a really combined strategy than if you had only 1 or 2 of those other sources.
So if you enjoyed this video, please leave a like and subscribe to the channel, and comment down below something that you didn't know that you learned in this video about taxable investments, and we'll see you in the next one.